Namaste and welcome. I'm Pratim Ranjan Bose and you are watching my podcast Perspective. In this episode, I'll discuss about world economy and China in particular. In episode 32, which was aired in June, I outlined that India's remarkable post-pandemic growth story came in the middle of unprecedented global political and economic turmoil. Never before, all large economies from US, Europe to China looked so vulnerable. India's Chief of Defense Staff, Anil Chauhan, summarized the political outlook. Quote, the world has not been as violent since World War II, unquote. Economics and politics are not mutually exclusive. Economic disruptions impact politics and vice versa. Closer home, in Bangladesh, the economic scenario had gone very since 2022. The country is now engulfed in a political turmoil which should further affect its economic recovery. Bangladesh is no exception. Worldwide, many governments changed and too many are vulnerable for change post-pandemic. The list of vulnerable includes the Joe Biden administration in the US. In comparison, India's Narendra Modi government has been strong and stable, which reflected in our economic performance. The reverse is also true. Good economics helped Mr. Modi to remain firmly seated in power with minimal loss in 2024 election. Having said that, the global situation might worsen from hereafter. In June, the chief economist of S&P Global pointed out that despite some improvements in the US economy, the recession risk remains above historical norms. To quote him, the peak growth is likely behind us in this post-pandemic recovery. We anticipate growth will soften to about 1.8% by year end. University of Michigan Consumer Sentiment Index was at a 6-month low in May. Both short-term and long-term inflation expectations remained above the pre-pandemic level. The fears became apparent last week. On August 5, the same day when army rule was imposed in Bangladesh, the global equity markets saw a bloodbath, fearing US recession and rising geopolitical tension. Stock prices fell sharply. S&P 500 and Dow Jones Industrial Average suffered the sharpest single-day declines in percentage terms since 1987. That was not all. On August 12, Oil Producing Nations Association, OPEC, had cut the production outlook for 2024, citing muted growth potential in China. The production cut will keep crude prices all stable, irrespective of the demand slowdown. And if the Iran-Israel conflict intensifies or some calamity strikes, oil prices may only go up, thereby increasing the vulnerability of the world economy. We saw that phase after the 2008 meltdown and particularly after the 2011 Fukushima disaster in Japan. In a parallel development, Bloomberg reported on August 12 that foreign portfolio investors pulled out a record $15 billion investment from China in April-June quarter. Barely 3 days before, on August 3, Financial Times reported that Beijing was trying to restrict its banks from selling 10-year sovereign bonds at a discount in the secondary market. Leaving aside treasury management part of the story, the key factor behind such discount sale was lack of faith on long-term performance of the Chinese economy. Are the fears real? This is not an economic class and I'm not into fortune telling, but I can only point at some worrying indications or trends. It is known that the Chinese economy was living on regular dose of stimuluses since the global financial meltdown in 2008. Its growth engine had become slow and unsteady since 2010. The US tariff war has been impacting China's export growth potential since 2017. Beijing messed up the pandemic situation, and for last 2 years, the Chinese economy is spluttering. Chinese property bubble, contributing a quarter of the GDP, had burst. The economy is facing a huge credit crisis, estimated to be bigger than the US crisis in 2008. The stock market has eroded huge amount of investors' wealth in last 2 years. Beijing is once again trying to solve the puzzle by using the known monetary and fiscal policy tools. On the one hand, the government is pumping money as direct stimulus. On the other hand, interest rates are lowered to encourage citizens to consume. The immediate task at hand is to boost domestic demand to compensate the loss in export potential. At a time when majority of the world, starting from the US to India, are following a tight money policy to control inflation, the Xi Jinping administration is reducing interest rates and offering special discounts as well. In July alone, Chinese central bank held special lending sessions twice at rock bottom interest rates. But the economy is not responding. Check these facts. Increased money supply should fuel inflation. That's a very normal reflection. But China is witnessing a near zero inflation for last 1.5 years. The Chinese consumer confidence in China is at 30-year low. For comparison, the consumer confidence index is down in both USA and the Eurozone. India is an exception to this trend. Here, consumer confidence is peaking. Despite huge stimuluses to revive demand for properties, the sector is witnessing sustained declining trend. All major indicators like sales of floor space, new home construction starts, new home completion, and property investments have been on a steady decline. According to S&P, the decline will continue in 2024. We have come across a strange situation, therefore, where money supply has increased in the Chinese economy, but it is not reflecting in demand for goods and services. The Chinese are not even investing in stocks and financial instruments. So where are they saving? What are they doing with their money? The answer is they are parking money in gold. Demand for gold has been shooting in China since last year. Initially, Chinese consumers were buying jewelry. Now they are buying more investable form of gold in bars and coins. The demand or sales of gold bars and coins have shot up by 46% in January-June 2024 period. This is the economic part of the turmoil. Politically, things are hotter. There are serious geopolitical reasons why Chinese government is investing in gold, and Delhi is bringing its gold reserves back from UK to India. There are also reasons why Saudi Arabia moved out of dollar-denominated trade, or why India is rolling out local currency exchange rates with UAE and Russia. There must be reasons why Chinese media stopped attacking India, and India has started offering visa to Chinese investors on a fast-track basis. The world has stepped into very uncertain times. This is akin to a war, but it will not be fought with, or it will be fought less with bombs. There are times when you need stronger political leadership than ever. All disruptions open new opportunities. Prime Minister Narendra Modi has steered India to growth in his previous terms. His current term in office will be crucial for long-term sustainability of India's growth. Thank you for listening to Perspective. If you like this episode, please share and subscribe. See you next week. फिर मिलेंगे. जय हिंद.